You say in the report that due to those persistent inflationary pressures, central banks need to continue hiking interest rates. At the same time, supportive fiscal policy is needed to help cushion the blow of higher energy costs. What is the proper balance of that, given we are seeing today the impact of fiscal policy plans in the UK absolutely roiling assets across the board?
Well, good morning. Our forecast certainly is a challenging one because we are forecasting a significant slowdown of the economy to, say, the United States growing at 0.5% next year, the euro area growing 0.3%, and still a slowdown in China this year, and next year recovering a little bit. But still, globally, we're talking about significant slowdown. We believe that right now the priority has to be, for sure, bringing inflation down. It's crucial because real incomes are going down quite significantly, and delaying adjustments would only mean that we're going to have problems on the line and probably even bigger adjustments to be made. So that's why we say very clearly that first of all, monetary policy should continue to tighten in the advanced economies. Also in the emerging markets, it's crucial that it's still early to undo the tightening that took place a bit earlier. So likely they'll have to continue to tighten a little bit. And together with this, it's crucial that fiscal policy works hand in hand with monetary policy, so that fiscal support is targeted and temporary, but also without leading to a substantially further stimulus into the economy, because a lot of economies have high debt levels, and it's not prudent to do so.
Well, and of course, there still remains a big energy question hanging over both monetary and fiscal policymakers. How do you model out the uncertainty around energy in economies like Europe, and what kind of downside risk it could pose to growth and upside risk it could pose to inflation?
Well, we have a scenario, in fact, that calculates this. So first of all, it's important to realize, especially for Europe, what are we talking about? So just to give you an idea, storage levels right now in Europe are about 90% in most countries. But storage levels, the capacity is only 110 billion cubic meters, whereas an average consumption during winter is about 290 billion cubic meters. So we're talking about a substantial gap. So even though many countries are trying to bring more supply to the fold, this likely will not be enough. So what we calculate is that we need to reduce demand between 10 and 15% in Europe in order to avoid gas disruptions. But we have a scenario that shows exactly that if we have gas disruptions and energy prices, especially gas prices, go up by 50%, what is the impact for the world economy? Well, we calculated that for Europe, for example, growth would be even lower, will be 1.3 percentage points lower than the already very low 0.3% growth forecast that we have in our central scenario. So basically, Europe will be in a big recession, or at least in a recession. On the other hand, we would have additional inflation of about 1.5% in Europe, and in fact, around the world, 0.5% more. So we're talking about the scenario in which if we have big energy disruptions, we would end up with even less growth and likely a recession in many countries, at the same time more inflation.
Okay, good to see you, Alvaro. There are clearly big global forces at work here. There's also domestic decision-making to be done. We sit here a few days after a big announcement from the UK on the fiscal side. How concerned are you about the trajectory of UK fiscal policy?
Well, first of all, because the mini budget came on Friday, and this was not still incorporated, and we don't know all the parameters. This was not incorporated in our forecast. So I should say that is important to say. Secondly, we believe that we reiterate our policy message. I think monetary policy needs to tighten now. And just to give an idea, right now we calculate that 80%, inflation is growing at, or prices are growing at more than 4% in 80% of all goods and services in the UK, which is higher than the euro area or higher percentage than in the United States. And on top of this, we believe that is quite important that, as I said, monetary policy works hand in hand with fiscal policy. So we reiterate the message. We believe that it's quite essential going forward, because otherwise the adjustment and inflation rising will be likely higher.
Although, Alvaro, we see, it seems to me, around the world, monetary policy working at cross purposes with fiscal policy. In Japan, in the UK, in the US, it seems that central banks are trying to make up for government moves.
Well, we believe that, again, we reiterate our message. We understand what is at stake here. We also understand, for example, in many countries, not only in Europe, but also in Asia, energy prices are going up fairly dramatically. So there is the need to support especially vulnerable households and potentially some sectors. But we think that is very important. If we want to get the job done as quickly as possible without big disruptions down the line, it's absolutely essential that monetary policy and fiscal policy work hand in hand. But, I'll give an example. Japan right now is a bit different case, because Japan inflation, even though is rising a little bit, is still very low level right now. So we understand the position of Japan. Of course, other countries like China, they don't have a lot of inflation right now. So there, the fiscal stimulus is working its way and will work its way a little bit next year. So it really depends on specific economies, but overall, in many countries around the world, monetary and fiscal policy should work hand in hand, so that we are not able, we don't get into a situation in which things get a bit more uncomfortable for all of us.